Hello, and welcome to the Money Magnet Learning Series, Module number 4, Protecting the Future, Insurance and Investing 101. My name is Jennifer Wallace, an independent insurance and investment advisor with Jennifer Wallace Insurance and Financial Solutions. Just a reminder that all the information discussed is based on Canadian legislation. So if you're watching from a different country, please consult a qualified advisor in your area for help. This learning series is designed so that you can go through each module in order from beginning to end, or simply select the topics that are most relevant to you. All right, let's get started. Many people don't want to even think about the future. They're too busy looking at the present. We're going to help you change that. This module is going to talk about some insurance basics to give you a great foundation of knowledge, wills and estate planning, looking at investing and some of the basic understanding that you'll need for that, and then moving on to way down the line, potentially planning for retirement. Insurance. Insurance isn't an easy thing to grasp. We all know what insurance is. It's all of those fine particular points of what is the differences between different kinds of insurance, how much things cost, what affects the cost of insurance, etc. So I'm hoping to just touch very briefly on high level explanations and knowledge for you so that you at least have a basic concept of what might be the best solution for you, and so that you're empowered to ask some great questions when you're actually sitting down and either looking at insurance you currently have in place or looking to purchase insurance that you might need to complement your financial plan. So, talking about life insurance, basically the purpose of life insurance is to provide a tax-free cash benefit to your beneficiary or beneficiaries, if there's more than one, upon your death, to be used for final expenses, outstanding debts, or to provide for future generations. There are two types of insurance: term insurance or permanent insurance. So looking at term insurance, which is certainly one of the more common kinds of insurance, it's basically just a life insurance benefit only. I say that term insurance is almost like renting insurance because there isn't any bells and whistles. There's no cash value that's going to give you money out of the insurance policy at any point in time. It is just there to provide an insurance benefit at a cost-effective premium for a guaranteed period of time. So there's 10 years, 20 years, 30 years. Sometimes you can get something smaller at 5 years. But usually that term insurance is that go-to for people who are just looking for that protection that doesn't cost them a lot. Term insurance also offers the ability oftentimes to convert to a permanent life insurance policy before the expiry of that term insurance. So this is great because if you suddenly become ill and wouldn't be able to qualify for a new insurance policy, and let's say you still have an insurance need at the end of that 20-year term policy, you can convert that without any additional medical into a permanent policy so that you have that for the remainder of your life. Moving on then to permanent insurance, there are two types of permanent insurance: whole life insurance and universal life insurance. So a whole life insurance policy is basically a life insurance benefit that includes a dividend option, which more or less is a cash within your policy. So basically the insurance company that you're purchasing that whole life insurance policy with is saying that based on a dividend scale that they have control over, and most of the times an insurance company will not reduce the dividend, they'll only increase the dividend or keep it steady for many, many years, depending on their profits as a company. That dividend that is paid into your life insurance policy, you can designate at the time of application what that dividend is going to buy for you within that insurance policy. So sometimes, for example, you can use it to just accumulate cash within your policy that you can then access later on down the road, or you can purchase additional life insurance amounts. So for example, let's say you're going to be getting an insurance policy, a whole life insurance policy on a child, and you want to start because of the cost with just a $25,000 life insurance benefit. But as they grow and become an adult themselves, their life insurance needs will increase. And so you can have that life insurance dividend be buying additional amounts of life insurance within that policy. So, for example, let's say by the time they reach age 30, that $25,000 base policy actually has a total benefit of, let's say, $100,000 of life insurance protection for them. So you've been able to use that dividend to purchase additional insurance for them, being able to maintain your costs at a relatively low rate as well. Or there are other variations of that dividend use depending on the life insurance provider. So they offer different things, and it's really just more of a what need you're going to be fulfilling with that insurance policy. So whole life insurance is a much more expensive option, and again can be useful for insuring some young children or for lifelong insurance needs because the policy will never expire if the premiums continue to be paid. A lot of business owners will look at a whole life insurance policy only because they intend to need that insurance for the remainder of their life, and they may have the business as the owner and payer. So a more expensive premium is not really a big issue. Another version of a permanent insurance policy is called a universal life insurance policy, which is kind of a hybrid between a term and a whole life insurance, although it does qualify as a permanent life insurance product just because there is no really specific term to the policy. So although the costing is similar to a term insurance policy, it has an investment option within it. So that investment option, if you choose as the payer on the policy to overfund the policy, so that means, let's say your cost of insurance is $50 a month, and you say, you know what, I'm going to be putting in $100 a month. That extra $50 goes into a tax advantageous investment option that can be accessed by you as the policy owner without actually having to cancel the policy. Whereas with some whole life insurance policies, to actually gain access to cash value within the policy, you would need to surrender or cancel that policy. So universal life, again, it's a more costly life insurance policy than a term policy, but it's also less costly than a whole life. So it's kind of in the middle, that hybrid blend. And certainly it had a really great run for many years, and now it kind of seems to not be quite as popular. There are a lot of companies that are no longer offering such a great cost on a universal life, but again, it depends on what your insurance needs are and what your insurance advisor can get you in terms of securing a decent rate that is in line with your budget. So if you do have a life insurance policy, then you are one of 22 million people in Canada who own life insurance. So congratulations. If you don't have current life insurance protection, then you're part of the other 11 million that don't. So certainly you want to be included in that amount of people who do own insurance, because life insurance is certainly a cornerstone to any healthy financial plan. When you're looking at life insurance, though, it's often confusing as to how much you might need and what's involved in the application process. So just a few seconds on when you're working with a qualified insurance advisor, they'll walk you through something called a needs analysis. So that'll help them to calculate the amount that you'll need in terms of life insurance. So it'll factor in all of the debt that you have currently. It'll also factor in if you want to be leaving, for example, some money to a charity, or perhaps money for your heirs, the next generation, education savings for your children or your grandchildren. All of those can be factored into that total insurance needs analysis calculation so that you are justified in what the amount of insurance coverage you're applying for is going to be. It gives you a great idea too, just to look at what your assets liabilities are, which will calculate your net worth as well. So that's a great exercise to go through with a qualified insurance advisor. If what your needs analysis produces as a result of the insurance gap that needs to be filled, if that falls outside of what your actual budget is in terms of premium, I always like to tell people that something is better than nothing. So as long as you're obtaining the right kind of coverage, having at least some benefits, certainly better than not proceeding with any insurance at all. Again, looking at the term insurance policy, for example, is a great alternative if you are more budget conscious, because you can be able to get the amount of benefit that you absolutely need for a much reduced cost than having a whole life insurance policy. And then you can convert all or portion of that term insurance down the road 10, 15 years down the road when your finances might be in a completely different position and you might be able to afford whole life insurance. So you don't need to go through an entire application process again. That flexibility is there with the term policy to convert it into a whole life policy for the rest of your life. And you'll never be without coverage. So once you've determined the type, the amount, and the company that you're going to apply for coverage through, basically, you just have to apply using an application submitted to the company. Depending on your age and the amount of insurance, you might need some medical, so you might need to get some blood drawn or have some vitals taken, which will all be arranged and paid for by the insurance company. So it's not really something you need to worry about, just being able to make the appointment with whoever might contact you to get that completed. Once you're approved, again, you'll receive your policy, which is a legal document, and then once you begin paying your monthly or annual premiums, you can choose how you want to pay that. That policy is then in effect until you decide to make changes or are no longer able to pay that premium. So that life insurance is really a set it and forget it. If you can do a really great needs analysis and a thorough financial plan, then you'll likely not need any additional insurance coverage unless something drastically changes. So for example, if maybe when you had your first needs analysis, you had a mortgage of $200,000 and then you decide that you want to build a great house because you're doing really well and your mortgage is now suddenly $400,000, you might need to adjust that, or you might not, depending on what you feel your other assets would be in combination for your estate plan. But speaking of mortgage insurance and changes in mortgages, mortgage amounts, and going and sitting with your mortgage lender, oftentimes that mortgage broker, who is not usually a life insurance advisor, they will talk to you about mortgage coverage, which is creditor protection for your mortgage. So this is a way for them to say that should something happen to you, that debt that they've extended to you will be paid off in full. The type of coverage, though, that is traditionally offered as creditor protection with a mortgage can cause a lot of headaches for some people. And there have certainly been a lot of instances, certainly in the Canadian media, that has seen people pass away and the claim is actually denied because of the application process that creditor protection involves. So a lot of the times that type of coverage, it only might ask 2 or 3 medical questions, if that. So you're not actually being fully underwritten, which is basically a full consideration from a health perspective of the type of risk you would be as a life insurance owner. So that insurance company needs to know, like, how likely is it that it'll be claiming within a short period of time. That process is skipped with the mortgage coverage. So the claim might be declined because you could have an issue with your health that, because you're not having the availability or the opportunity to disclose that at the time of application, you don't know that you would not be approved for coverage otherwise. So perhaps you then pass away and your partner or spouse claims to have that mortgage paid for the insurance, and then it's deemed that, oh, we can't pay because there was a pre-existing condition at the time of application, which was not disclosed because there wasn't an opportunity to disclose. So I always like to tell people, you know what, it's not the best kind of insurance coverage because it's really not fully underwritten to protect you as the consumer. But not just that, it's also the most costly kind of insurance per unit. So basically, per $1,000 of insurance coverage, you're paying more than you would if you were to go and buy a term policy for that same amount. And I'll tell you why. It's because this mortgage insurance, you're paying down your mortgage each month. But when you first sign that mortgage coverage, you have a set premium. Let's say, for example, that set premium is $60 a month. As you pay your mortgage down, your insurance premium isn't being reduced as your mortgage is being reduced. So you end up paying more for a shrinking amount of coverage. I'll say that again. You end up paying more for a shrinking amount of coverage. So a lot of the times when you're looking at your overall life insurance picture, including the mortgage and not having a creditor protection policy on your mortgage, saves you a lot of money in the long term, and it's just a much more protected way to insure your mortgage. $417,000 is the average protection per insured household in Canada in 2017. So that is per insured household. So for example, you might have two partners in there with a little over $200,000 of coverage each. When I see that number, I think that's a little low, mostly because of what people's mortgages tend to be right now. A lot of the times you're sitting down and the mortgage alone is over $300,000. So you're wanting to be able to have that covered off in the event of the death of either spouse. So keep in mind, if you're looking at your own, again, in reflection, if you have less than that amount as your total insurance, maybe you should just do a needs analysis with your advisor and make sure that your complete picture is being accounted for in your life insurance. If you don't have life insurance, then certainly I can help you go through a needs analysis and see if there is something that can be filled with an insurance policy in terms of a gap with your estate planning. Now, there's more than just life insurance available to Canadians. So there's also disability and critical illness insurance. Oftentimes people confuse the two of them. It's difficult to know what is what and what covers what illnesses or injuries or anything like that. So let me just kind of take a second and dispel some myths, but also really have you have a clear understanding of what each of these kinds of insurance policies are. So a disability insurance or income protection insurance policy, it gives you a monthly benefit if you're unable to work due to illness and or injury. So this is basically replacing your income if something happens to you that prevents you from being able to work for a period of time. So if you do have a group benefits policy with your employer, then you may already have a disability insurance component in your plan, which is great. Make sure that you check that, make sure that you understand what the benefit is, how long you need to be disabled in order for that benefit to kick in, and make sure that you know exactly who needs to be contacted in the event of the need of a claim submission. Disability insurance is basically for anybody whose lack of an income would affect the household. So if you are not able to work due to illness or injury, and you weren't able to basically earn an income, how would that affect your household? Would some expenses not be covered? Would your mortgage not be paid for those months? Even if you look at somebody who isn't perhaps actively working and earning an income, they too can have a disability insurance policy because, for example, if they are a caregiver to either children or perhaps an elderly parent, if they're not able to do their duties that they carry out each day, even though they're not being financially compensated for that, there would be financial repercussions because you would need to then pay for someone else to come in and do those duties for them in that period of time that they're not able to complete those activities. So there is a financial repercussion on the household expenses as a whole. With a disability benefit, that monthly benefit is determined by your annual income, or if you don't have an annual income, you can designate an income that would equate to the expenses your household would incur in the event of your disability. You can design the policy to suit your needs in terms of the waiting period and the benefit period, so how long it will pay while you're still on claim. A good rule of thumb generally is to have 3 months of your household expenses away in savings account or emergency fund. So the common waiting period is 90 days. Now, this can be changed. You can have as little as 30 days. You can have up to 180 days, but generally 90 days aligns with what people can float in terms of their household expenses. As well, it allows for that premium to be a little more accessible a lot of the time for people, as opposed to a 30-day where it costs them a bit more per month in the premium. Your waiting period, your occupation type, which defines your amount of risk, your age, sex, your benefit amount, and the benefit period all affect your cost of insurance. So when you're looking at, okay, yes, I need disability insurance coverage, but yes, I have a budget that I need to stick to, how can I design a policy that will provide me with at least the minimum benefit amount and a strategy to be able that if something were to happen, my financial security would be protected. I wouldn't need to suddenly rack up debt that I've just worked so hard to pay off because I'm suddenly unable to earn an income for 6 months due to an illness or an injury. Plus, you've got additional perhaps medical expenses on top because of whatever circumstance is going on with your health during that time. So the disability insurance coverage certainly is a costly type of coverage, but it's widely used. It can be claimed against multiple times within your lifetime. During that policy, as soon as you go off claim, that policy stays in effect. So you can have 2 or 3 claims on the same policy. It doesn't necessarily affect your premium. But while you are on claim, then you don't have to pay the premium on that policy, but it does remain in force. So disability insurance is basically for anybody who has an income or whose inability to conduct certain activities within the home would incur additional expenses. If you do not have a disability insurance policy, then you should really look at, okay, is this something I need, and have a serious conversation and view over how your inability to earn an income and bring that into the home would affect the overall financial picture at 9 months or at 12 months or at 2 years even, of having no income coming into your house. Don't always think short term, think long term, because certainly that is a very common thing to happen with people having injuries and having surgeries, multiple surgeries, recovery time, rehab, all of those things. It certainly can take you almost a year oftentimes to get back into the full ability to carry out your normal daily duties. Moving on to critical illness insurance. So again, unlike disability insurance, which provides an income replacement in terms of a monthly benefit, a critical illness policy, it offers a lump sum tax-free benefit when you're diagnosed with a qualifying life-threatening illness. So again, it's cancer that's life-threatening. Each policy has their own list of what illnesses would be included in that insurance coverage. So it's really taking a look and saying, okay, how many? A lot of policies have around 30 illnesses that would be covered. So it's really, as soon as you're diagnosed, you want to be, if you have a critical illness insurance policy, talking to your advisor to say, is this covered? This is what my diagnosis is. What do I do to actually complete the claim process? And really find out all that information, but know well in advance what kinds of coverage you actually have in great detail if you can. Obviously, you're not going to remember every single illness for the rest of your life when you have a critical illness insurance policy. But more and more, we're seeing in the industry critical illness insurance being claimed against because medical advances are such that people are receiving treatment, they're returning to good health, and they're able to not have to resort to a life insurance claim because they are staying healthy for the rest of their life. That critical illness insurance benefit to them allows them to seek treatment, take time off work, adjust maybe perhaps some medical necessities in their living arrangements, or seek even just paying off their mortgage or seeking treatment alternatively. It's really, there's no specific use for it. It's literally a tax-free benefit that's paid to the claimant for them to use as they would like. So that kind of insurance is certainly not one you want to have to use, but it's one that is a lifesaver if it ever does come up. It's not always easy to qualify for, depending on what your family history plays a role in, as well, just your own personal medical history. So obviously, because it is a critical illness insurance policy, it is much more heavily medically underwritten than your life insurance policy would be. And even your disability insurance policy. Disability insurance policies can be heavily scrutinized from a medical perspective as well during the application process, but certainly critical illness insurance application process has a lot more involved in it just to make sure that the risk is accurate for the insurance company, and then the offer of coverage would be released once the decision's been made. So again, similar to life insurance, the process of application is the same. You would apply, you would provide any information that's required. With disability insurance, oftentimes you need to require the submission of either an income tax return or a pay stub, depending on what your employment situation is, just to verify your income, so that they know that you're actually getting coverage for the appropriate amount of income that needs replacement in terms of illness or injury. So 12 million Canadians in 2017 owned a disability insurance policy in Canada. That might seem low to you, but when you look at the makeup of Canada and how many people are perhaps retired, that would no longer need disability insurance coverage because they're not actively earning an income, that's a pretty significant number. So if you do not have disability insurance coverage or critical illness insurance coverage, certainly take a look and see if that is something that would benefit you and your family to be able to protect your most important asset, which is your ability to earn an income. Now, if it comes down to one or the other, because your budget doesn't allow you to purchase both disability insurance coverage and critical illness insurance coverage, I always advise people, if it has to be one or the other, to choose disability insurance coverage. And I'll tell you why. Disability insurance, even though it does only produce a monthly benefit, it's a monthly benefit that's easier to qualify for than critical illness insurance would be, right? So that critical illness insurance policy only covers that 30 or 34 illnesses that are outlined in the policy. So the odds of you getting that specific illness may be less than the odds of you just not being able to work because of illness or injury, right? So that qualification period and just that qualification need really has to come into account if you're going to be looking at where the smart dollars would go. So again, that disability insurance coverage over critical illness. But again, if you can have both of them in your financial plan, you're certainly in the best shape possible then. We've mentioned estate planning. So estate planning is basically what you're going to do to make sure that the transfer of wealth to the next generation is seamless and cost effective. So one of the vehicles to facilitate that transfer of wealth is a will. So everybody's heard of a will, a last will and testament, which is a legal document that outlines, in the event of your death, where you would like your assets or your dependent minor children to go. So a will is most important, definitely when there are minor children involved, and that's just because if both parents happen to pass away in the same incident or same event, then if there is no will in place, those minor children will then become wards of the provincial government, wards of the province, until permanent custody arrangements are made and decided upon by a family court judge. So again, you've got these children that are traumatized by losing both of their parents, are suddenly now thrown into foster care until a decision is made through the family court as to who should have custody of those children. So having a will negate all of that, unless there's obviously a contest to the will. But having that will at least say, you know, these are the wishes of the parents, that the children would be with whomever. So that document just is so vital when you have children involved, just for their own safety and security. But if you don't have children, do you still need a will? So this is a question that I'm asked quite a lot, actually, by people who don't have children, but do have significant assets. They might have, you know, a rental property and a primary residence and some investments. And I say, yes, as soon as you have real estate, so anything that's a substantial property, real estate, especially if it's not owned with a joint tenant, then it will just go into basically coming in through the estate. So that's a whole other tax issue that you want to avoid, and you can avoid quite easily just by having a will. So that will be able to designate, okay, that property will have the ownership transferred to my sister or my daughter or whomever the case might be. A life insurance policy comes into the estate planning picture also because they're going to be designating beneficiaries for the funds in the life insurance policy. But you can also use your will to be able to be more in depth in terms of the receipt of those funds. So that will can say that the time that the trust would be open to the children. So it could be at their age 25. It could be, 20 years after the trust was created. Whatever your desire is, that will can easily lay that out for that executor or trustee to be able to use as a reference. Having a power of attorney. So the power of attorney is basically the legal document while you're still alive for someone else to be able to act on your behalf and make decisions for you regarding your own personal self or property. So the power of attorney for medical care is vital if you're incapacitated and medical decisions need to be made. That power of attorney will allow someone to make those medical decisions and authorize the medical personnel to carry out your wishes. Power of attorney for property is great if there's incapacitation and you are still alive and have bills to pay and have financial obligations that need to be carried out. That's a way for someone else to act on your behalf and have access to be able to make all those arrangements on your behalf while you're incapacitated. An executor isn't necessarily the power of attorney, but is the person who comes in at the time of death and basically goes through the wrap-up of your estate. So that executor position has changed in recent years in Canada. New legislation's been introduced that basically has more liability sitting on the executor of an estate. So that's for basically if there's a miscalculation of assets, which will then significantly impact the final income tax that's filed, and perhaps any income tax that's owing to the Canadian government. So again, they're stepping up and saying, we want people to make sure that if they're being the executor or executrix of a estate, that they're doing it properly and with care and due diligence for sure. Because of that, however, the executor position is now something more complex, that they have a lot more liability in terms of penalties in the hundreds of thousands of dollars that they could have personally. That's not on the estate. That's personally to them as the executor, because they're the ones who have misrepresented the estate in the final return, or even jail. So again, this is something that an executor might not even be misrepresenting anything on purpose. They could just have assets in the estate that they're not aware of the actual value, and they're not getting the proper evaluation of it. So perhaps that antique that they thought was worth $500 is worth $50,000. And so there's that misrepresentation without their knowledge, but they are still liable for that because it's up to them to be getting a proper evaluation for those assets. As a result, there's actually executor insurance coverage now available to help cover that individual. So it's similar to like a professional liability coverage policy. And so it's more important for them to be able to look at everything and have that comfort knowing if they do decide to have an executor insurance policy, that they do still go through the estate with the utmost care. And it also, it puts the executor into a whole different ball game, I think, because now, where you might have your sister or your cousin be the executor of the estate, thinking, oh, it's easy to complete. Now you might want to sit and have a further conversation about changing that to someone who perhaps is a little more knowledgeable about what goes into executing. Did you know 51% of Canadians do not have a will in place? And that's in 2017. That's pretty huge considering the amount of people who do have assets and do have homes and do have children even that don't have a will in place. That's staggering. So if you do not want to go into a lawyer to obtain a will, then there are certainly even just legal will kits. Having something written down, though, and even taking it into a notary and having the signatures notarized by a notary is a lot cheaper than going and getting a lawyer to do your will. But at the same time, it's covering you, and that's still a legal document to stand up in court for you after your death. So wills and estate planning, the benefits of estate planning, we've gone over a little bit. So those benefits include just being able to properly see what implications to the next generation there will be when you're transferring your assets and your wealth upon your death. So that advisor can help you map out where you want things to go. Again, looking at the options to cover things such as capital gains tax on family homes or vacation homes, or on investment assets, because investment assets, as soon as they're going down to the next generation and not to a spouse, they then have some capital gains tax that they need to take care of. So using, for example, life insurance to be able to cover whatever potential tax there could be is a great estate planning mechanism. So basically what your estate plan can do for you is ensure that your heirs are getting exactly what you want and expect them to. So you know that, okay, because of my proper estate plan, the assets will definitely go and won't be having to go to the government for tax. They'll go to my heirs instead. Estate plan will also ensure that there's no difficult transfer of wealth to the next generation. So it'll become a seamless thing because it's all been planned out well in advance. It'll allow you to use life insurance protection so that you can give some assets to the next generation while they're still alive and you can watch them enjoy it. So this allows you to be able to make sure that instead of having some investment assets there to pay your tax liability, you use insurance to pay that liability instead, so that you can give that cash to your heirs, your children, grandchildren, whatever the case might be, so that they can use it perhaps when they need it, or you can watch them enjoy that while you're still with them. And again, it can lighten the load for your executor, having things well mapped out. It certainly makes their life a whole lot easier. So when should you get a will? A lot of the times people think, oh, I'm too young to get a will. Certainly 25% of Canadians say that they're too young to worry about a will and estate planning. But anybody that buys a house, has property, or has children, they should be going directly to that will planning stage and looking to be getting their will and power of attorney completed. Moving on now to investing. So investing 101, there are certainly so many different options when it comes to investing, and I think it becomes very overwhelming for people. They don't understand the difference between the legislation of an investment contract versus the actual type of investment contract. So by that I mean legislation. There are two kinds of legislation generally in an investment contract in Canada, and that is a registered or a non-registered. So a registered contract for an investment is something like an RRSP, a RIF, an RESP, an RDSP, or a TFSA. So those are all contracts that are registered with the Canadian federal government, so CRA, Canada Revenue Agency, meaning that they're linked to your social insurance number and tracked for tax or contribution limit purposes. So for example, your RRSP, you get a tax deduction. So that account is automatically attached to your social insurance number so that the Canada Revenue Agency can verify that you did indeed contribute to that RSP and are eligible for that tax deduction. Non-registered accounts, however, are any other investment contract or savings account that's not mentioned as one registered or anything like that. So that's just like anything else that's not a registered kind of contract is a non-registered, or an open contract is also another phrase for it. So let's break down the different kinds of legislation and kind of the ins and outs of each of them. So an RSP, or a Registered Retirement Savings Plan, is one which you receive an income tax deduction at your current rate when you contribute to the plan. So let's say your rate at the time of contribution is 28%, your marginal tax rate, but then you're taxed when you withdraw. So that's then becomes withdrawing it as an income. So then when it comes back into your income, it's actually taxed at the marginal tax rate at the time that you're withdrawing it. So let's say you contribute at 28% marginal tax rate. Maybe you're starting out in your career and you're putting that contribution in, thinking it's going to be great. But then when you actually have to withdraw it, you're at a 48%. So you're actually having to pay more tax on than you ever got back for that contribution. So it can be kind of tricky that way. Also, a registered retirement savings plan was created by the federal government to encourage Canadians to save individually for their retirement, so they weren't completely dependent on Canada Pension Plan, Old Age Security, or other government benefits, because more and more businesses weren't offering pension plans anymore. The old pension plan game has kind of gone by the wayside at many different kinds of Canadian companies. So that RSP was created with the intention of you saving for your retirement. So if you want to go and withdraw money prior to your retirement, you're subject to a penalty, which is it's called a withholding tax. So that's a percentage based on the amount that you want to withdraw. Because you're withdrawing before retirement. So there's also potentially applicable charges with your investment company, which we'll talk about later in this module. But you could end up paying quite a lot of money to be taking money out of your RRSP prior to retirement. Now, for the money that you do save in your RRSP until retirement, that RSP is converted into what's called a RIF, or registered retirement income plan or income fund. So that is what your RSP has to convert to by the end of the year in which you turn 71. So you can start converting that RSP money into a RIF as early as 55 even, but you absolutely have to have all of those funds into a RIF by the end of your year that you turn 71 in. So there is that limitation for you. And then once that's converted, once you're starting to draw an income from that RIF, there again is some legislation where the government says this is the minimum and this is the maximum that you can and have to draw annually out of your plan. And that's based on your age and the market value in your plan on January 1st of that calendar year. So all those amounts that you withdraw are subject to income tax at your current rate. So again, if you put that money in and you got 28% tax deduction at that income tax rate, but then 45 years later, you're taking it out and you're at a 42 or 48%, you've essentially given some extra money back to the government because they've gotten a really great deal because of that change in your marginal tax rate. So just a fun fact that 38% is the number that Canadians' investment funds account for of their overall financial wealth. So that means that of an average Canadian, their overall financial wealth, that investment fund is 38% of that. Moving right along with our Investing 101, we have the newly introduced tax-free savings account. And that was just introduced about a decade ago to help people save personally for retirement beyond an RSP. So an RSP, as you may know, it does have some contribution limits, which are on your notice of assessment each tax year. It will tell you what your limit is, and that's just based on the amount of income that you've earned in your lifetime. So there is a limitation to what you can put into an RSP, and that's why they said, well, let's give you a tax-free savings account, Canadians, so that you can have some additional tax-advantaged savings for retirement, right? But it's not just for retirement, because a tax-free savings account can be used for anything, whether it be vacation savings, short-term savings, if you want to put money aside for major purchase or anything like that, then the TFSA is a great way to do that. However, you are subject to contribution limits. So it started at $5,000 a year and has incrementally increased with inflation. In 2019, the contribution limit was increased to $6,000 per year. And any unused room since the inception of your TFSA, or your eligibility if you turned 18 after the TFSA was created, that unused room rolls over year to year, right? So if you were contributing for the first time now, you might have perhaps like $55,000 to $60,000 of available TFSA room that you could take advantage of. The great thing with a TFSA, and one reason why a lot of younger people are using a TFSA instead of an RRSP, is that you can take money out at any time without government penalty or taxation. It still may be subject to fees with your investment company, and that depends on certainly what that account is set up like. But keep in mind that TFSAs can be actively invested. So you might see some ads with different banking institutions or different financial companies that say, oh, we can give you a tax-free savings account with a rate of 3%. Well, a lot of actively invested tax-free savings accounts are getting 8 or 10%. So you can certainly do whatever you want. That TFSA legislation is just there as legislation, and you can choose to fund that TFSA using whatever kind of investment you'd like. An RESP is, again, a registered education savings plan. So this is another way that the government has said, we want you to be encouraged to save for your child's education, or even an adult's education, because an RESP can also be used for an adult. with available grants from the federal government based on the amount of contributions. So this is also open for any relative of the child to be the subscriber of and contributor to. So a grandparent, for example, can open an RESP for their grandchildren and be putting that money in there and still be able to get those government grants additionally to what they're contributing. That RESP, however, is restricted. So again, it's registered, so it's tied to social insurance number of the contributor. And also, in order to access funds from it, you need to be able to produce proof of enrollment in an accredited institution, and the amount that is being asked for has to be justified. So there is that restriction on it. If for some reason there is no need for education funds from that RESP, for example, if the person that the RESP was set up for gets a full scholarship to the school of their choice and they don't need to access any of that money and can't access any of that money because there is no actual funds needed to pay for their education tuition, then this is the bad part with an RESP, is that it then has to go into the contributor's RRSP, keeping it registered, right? So that all of the government grants would be returned to the government of Canada, and the remaining funds, including the growth that it has experienced as an active investment, has to be rolled into that RSP. So if that person then wants to give that money to the child going to school for, let's say there's additional expenses, or maybe they'd want to save it and give it to them to put a down payment on a home in the future or anything like that, it's now in their RSP. And so then they're going to be subject to even further withdrawal fees and taxation if they want to take that out to give that to their child. So RESPs aren't certainly the only game in town for education savings. It certainly has a lot of restrictions, and I always encourage people to be very aware of when they get an RESP plan, what all of those restrictions are, so that they fully understand what they're getting involved in and they don't lose any of the money that they contributed to that. For people who might have a disabled child or beneficiary in their life, an RDSP, or a Registered Disability Savings Plan, is a way for those relatives to set up something to bring future income for that beneficiary. So it's a way to say, if we're not around as parents or grandparents or aunt or uncle of that disabled child when they're an adult and still living, then they will have a savings plan to be able to give them money beyond any other additional benefits that they would qualify for. So do you contribute to an RSP or a TFSA? If you do, you are one of 65.2% Canadian households that made a contribution in 2015. So congratulations. Now that we've gone through the legislation around the different investment accounts that are available to Canadians, I want to talk about what can go into those accounts. Again, remember I said that there's a difference between what goes into an account and the actual legislation or registration on an account, because anything can go into those RSPs or TFSAs or RESPs. So let's break down. Now, this is very high level, and I'm really simplifying here because there are certainly a whole lot of other things that can be included. There's certainly a whole list of different kinds of stocks, bonds, commodities, debentures, etc., that you could be purchasing to put into an investment contract. But we're just going to keep it simple and keep it for an average retail investor or consumer. If you have questions, though, certainly let me know, contact me, and I can provide more information and more in-depth analysis for you. So keeping it simple, looking at stocks. So again, for a more savvy investor or somebody who has confidence in a stockbroker and a relationship there, then they can certainly have just an entirely self-directed or managed by a stockbroker stock portfolio. Stocks, again, you're investing in one specific company, you're buying a block of units of stock. So a lot of stocks, for example, will sell in blocks of 100 units. So you can't just go and buy one stock. You can, so let's say, for example, that you're buying a stock that is worth $10. You can't just go and buy a 1 unit of stock for $10. You would need to perhaps buy $1,000 worth of stock. So it'd be 100 units in a block that would sit in your portfolio. So again, stocks, you're investing directly in a company. It has a lot of moving parts to it, a lot to understand, and a lot of risk if you're not a savvy investor and you're going to be doing some self-directing. So it's really important that if you are choosing stocks as your method, that you really understand what it is that you're doing, and that you stay on top of it. It is a very active kind of portfolio to have for an investor. So it's really for people that if you either are financially inclined or just really love the stock trading as a hobby, then it's certainly something to look at. Similar to stocks, but the more conservative side of stocks is bonds. So you've got individual units of debt, again, similar to stocks. You're buying them in a block of units. And again, it's anything from government to corporate debt that you're buying that's guaranteeing a certain rate of return. So that will, after a given amount of time. For example, you might have a Government of Canada bond that's a 20-year bond and has a yield or a rate of return, interest rate, of 7.6%. So that means that the maturity is 20 years, and at the end of that 20 years, there would be a 7.6% payout. So if you held it for less than 20 years, you'd be getting a prorated amount of interest on that. You likely have heard the term mutual funds. Whether you understand what a mutual fund is or not, that's okay. But that's certainly a very common tool for people to use in their investment portfolios. What a mutual fund is a managed fund where a portfolio manager is at an investment company and they basically have a mandate or a description of the fund that guides them in selecting the best stocks or bonds available to include and adjust any percentage of holdings as necessary. So let's say, for example, that you are into Canadian energy companies, right? So that's the mutual fund that you're going to be managing as a portfolio manager. So you're selecting the best of the best in terms of the Canadian energy stocks. So that might be that you want ones that are really undervalued, and so you want to be able to make some money off of them or whatever, but they're doing the work for you so that when, as a consumer, we're buying a mutual fund for our investment portfolio, we're not having to do the research into those energy companies. We're not having to decide which ones we want to include in our holdings. We're just buying that Canadian energy mutual fund and saying, okay, we're going to have $50 a month going into that fund and purchasing whatever amount of units can be purchased. So again, there's more flexibility to be taking a portion of that mutual fund as opposed to having to take a whole block of units, because that whole mutual fund is purchasing those large blocks of units of stock. So that mutual fund is purchasing, like, for example, 100 blocks. So they might have, 10,000 units of a certain stock within that mutual fund. So as a retail investor, consumer, you're able to get in on that action without all of the risk of having to put all your money into just one single company. So a mutual fund can also include things like a GIC, or a guaranteed investment contract, or guaranteed interest contract, depending on who you talk to and how they reference it, which is Similar to a bond, but they're more for that consumer, for us, going to our investment company or our banking institution and buying a GIC. They're saying that, okay, you're going to give us $1,000 for a GIC. We're going to guarantee that at the end of a period of time, we're going to give you a certain interest rate on that money. GICs can work in lots of different ways with lots of different interest rates, dependent on the periods of time that you're going to be having that money invested. Generally, the longer the period of time, the higher the interest rate, because the institution has more opportunity to make money off of your money. Similar to mutual funds and also being able to access GICs are segregated funds. So segregated funds operate like a mutual fund in the way that they're structured, the holdings that they have, the type of return on investment that they're able to provide, but they add a lot of other things because of the legislation that they fall under and who offers them. So they're regulated under the Insurance Act. So insurance companies alone can offer a segregated fund. A normal investment company cannot, unless they're also going to be offering a segregated fund. Depending on the certain company, a lot of them can, for example, RBC has an RBC insurance branch, so they're able to offer segregated funds under that branch. So they are able to offer protection, so insurance on your investment. So for business owners, for example, you can have creditor protection attached to that, so that if something were to happen with your business or you were to be sued because of that, you have creditor protection that no one can access those assets in the event of bankruptcy or a lawsuit. Also, as a benefit to a segregated fund, is the ability to have it bypass probate. So for estate planning purposes, this is crucial because your will and your entire estate assets, if they go through probate, which is a process of the court basically signing off and verifying that the assets are going to where they're supposed to be by the will, that then becomes public record because it's gone through the court system, through probate. And so someone can go and actually access that information to see, oh, John Doe had $250,000 of investments that went to Jane Doe, or went to some total stranger. So people can access that information. So if you are conscious about that and you want to be able to not have that and also save costs on probate fees, because probate fees are court costs that are a percentage of your total estate that's under probate. So the larger your estate assets, the more cost there is for probate process. So by having those assets come out of probate, out of your estate for probate purposes, you're actually saving money as well. So you're protecting your privacy and you're saving your money there. And any investor really can take advantage of a segregated fund because there is that additional protection. The fees are slightly higher than a normal mutual fund would be, but oftentimes there's that additional protection just gives you peace of mind. Additionally, segregated funds offer a maturity benefit guarantee and a death benefit guarantee. So maturity benefit guarantee means that that insurance company is saying, we're offering and extending this investment to you. However, we're going to ensure that you don't ever lose more than 25% of that contribution. So if, for example, the stock markets fall 40% like they did in 2008, 2009, you would be covered. You would basically have 15% of that loss insured if you had to cash that money out, because let's say you were retiring and you had to start taking money out of that. So that's a great thing. And then same with at death. So if you were to pass away and there was that 40% loss, then that insurance company would actually kick it up that 15%. So your whole portfolio would only have a total loss of 25%. And that's the most it could ever have. So are we all confused now? Hopefully not. But that's a really simple, high-level explanation of stocks, bonds, mutual funds, GICs, and segregated funds. So again, any of those, depending on where you're taking your investment business to, the institution you're working with, the level of comfort that you have in terms of your own direction of investing, it really will speak to the kind of assets or funds that you put into your investment account. For mutual funds in November 2018, Canadians had a combined total of $1.47 trillion sitting in mutual funds. Can you believe that? Is any of that yours? Check your reports, see what your investment funds say, and see if you're part of that 1.47 trillion. If not, then get in on that action for sure. So we've mentioned it a couple times already, and that's about fees. This is probably one of the most contentious parts of investing, and certainly something that a lot of people talk about. A lot of advisors don't necessarily like to disclose the kind of fees that are associated with the investment that they're doing on behalf of their clients. I, for one, am all about transparency as an advisor. I like to make sure that clients understand exactly what they're paying for, how they're paying for it, if it's coming as a percentage of their rate of return, or if they're actually having to pay it in addition to any rate of return, or if they're having to pay it directly to me out of their own pocket, things like that. So there's certainly a lot of different scenarios. I'm just going to kind of walk through a few that are the most common for sure. Because you're buying professional advice, you're buying the actual transactions of purchasing a stock or a fund. So all of that costs money, and that's just the world that we live in. So it's all about understanding and being aware of what those charges and fees are. So if you're choosing to self-direct the purchase of stocks or bonds using either a stockbroker or maybe your bank's online portal, you'll be subject to transaction fees. So those are basically charged with every transaction. So similar to in your bank account, it's when you're buying or selling a stock or a bond unit. So that's every time you're making a sale or a purchase, you're going to be charged whatever. And each institution is different, and sometimes you can buy a monthly membership and have so many trades included in that, or whatever the case might be. It all depends on really what you need and how active you're trading within your portfolio. If you're an advisor or your bank, or at your bank, if you're using an advisor or your bank, then you're purchasing mutual funds or segregated funds, you will have some management expense ratios or investment management fees. So those MERs or IMFs, whichever terminology you want to use, they're basically the same thing, and that's a percentage of the rate of return based on the management level of the fund. So basically how actively managed that fund is. If it's a really aggressive fund, then you're going to have a higher MER than if it's like a bond or a fixed income fund that's really kind of just a whole bunch of corporate and government bonds in there, and there really isn't a lot of trading happening on it. So those fees, those management and expense ratios, are paying that portfolio management team to actively manage those funds, to basically make you money, right? So they're being paid to do their job so that you actually get a decent rate of return. So those MERs are actually not ever seen by you in terms of a fee on a report. How those are paid is that, let's say that investment fund that you're investing in has a gross rate of return for that year of 10%. And let's say that there has an MER of 2% on that, then that means that your statement that you get will show a net rate of return of 8% gain. So you yourself are experiencing an 8% gain on your investment assets, because that's including the management expense ratio already being paid to that portfolio management team. So you don't need to worry about writing a check to that portfolio management team. You don't need to worry about, is that fee going to be listed and that's something above and beyond what my portfolio is making for me? That's all taken care of for you. Different advisors as well, depending on the advisor and the client investment, have either sales charge or commission. So be sure to know and talk to your advisor to know if there is a sales charge attached, when that sales charge will dissipate, and what the parameters are in terms of the amount and why it's there and what it's for. 2% is about the average MER. So now that we've covered what your investments can look like, let's talk a little bit about retirement planning. So again, this is part of your overall financial plan, is planning for what your retirement's going to look like. Don't just focus on this is how much money I need to have in my retirement assets when I retire, because you're not going to be withdrawing that entire amount the day that you retire. So keep that in mind, and also think about what your lifestyle during retirement is going to look like. A lot of the times people think that they're retired, they're not going to be spending as much money. However, you may have some hobbies or some additional travel that you wouldn't normally be having while you're still in your career years. So you need to be thinking about what that retirement lifestyle is really going to cost you. Be realistic about it. Factor in inflation, especially if you're more than 10 years out from retirement. You really want to take a look at that, as well as the potential for health issues and additional medical expenses, or having to perhaps go into a retirement living facility in your later years, so that that expense is accounted for, because it certainly may cost more than when you first retire and are in really great health. Talking to an advisor, certainly doing a retirement plan with somebody who is qualified and can give you additional tax and estate planning tips is a great way to make sure that you're on track for your retirement, and to be able to have some forecasts for you, so you know, based on what you've done so far, what that retirement lifestyle might look like. Some tips for retirement planning, because tips are always so much fun. Remember that it's your desired retirement lifestyle, not your current lifestyle again. Um, Aim to retire debt free. Again, this is all part of everything we're talking about in the Money Magnet learning series, is getting debt free and keeping debt free all the way through retirement. If you're going to be downsizing, make sure that you don't have a mortgage when you're going to be going into your perhaps your downsized home or condo. Make sure that you keep your expenses within your limited income during retirement, and take that into consideration when you are in your last years of working, what your expenses look like and what you might need to be able to actively pay off before you're fully retired. Remember that many of the income amounts that you might have being deposited each month are actually gross, and not gross as in disgusting, but gross as in they have not accounted for tax. So you'll be on the hook for an income tax bill each year, and you need to plan for what that income tax bill might look like. So again, that's crucial for the use of your proper tax and estate plan to come in during retirement. And creating pools of taxable and non-taxable income sources to pull from. So this is crucial as well, because you don't want to have all taxable income. You don't want to have just RIFs, your government benefits such as Canada Pension Plan, CPP, or Old Age Security, OAS, that are all taxable, and you have nothing that you need to if you need to draw a lump sum from, right? That can be something that really comes up if there's a large medical expense or even a travel opportunity, and you want to be able to pull out $10,000. Well, you can't. You have limitations with a RIF, so you want to be able to have something such as a TFSA, or even just a registered or non-registered open account, to be able to have a pool of money to draw from, because that'll just make your retirement lifestyle that much easier from a financial standpoint for you, and from a tax perspective as well. So if you think that there's a magic retirement number that you should have, I've heard people say, oh, I need to have $1 million when I retire. That's really very different for everybody. There isn't a magic number. It depends on what their retirement lifestyle looks like. More and more people are expecting to work part-time during retirement because they want to stay busy. It's not that they need to financially, it's that they still want to be earning an income. So they don't want to be drawing too much from the retirement, or else they're just going to have to pay additional income tax. So it's really kind of looking at, okay, what is that going to look like? What's my retirement lifestyle? And really, what are my expenses going to look like? Again, retiring with a mortgage, you're obviously going to have a need for a greater income than if you had no mortgage come retirement and no debt. So it's keeping that in line, and it's also looking at what are you going to be giving the next generation while they're still alive. Unfortunately, more and more young adults are going and asking for help financially through their 30s and even into their 40s. So you've got retirement looking a lot differently in terms of cash flow nowadays, I think more than ever before. So moving on, there are some fun things for you to look at with this module, and that's one thing is, what type of investor personality are you? So it's an investor profile questionnaire that's available for you to complete, just to see, like, are you an aggressive investor? Are you a super conservative investor? What are your feelings and thoughts about investing? And to see if you are currently investing, if you fall within where your profile quiz actually has you allotted. So that's a really great double check system for you to see what you're doing. Also take a look at, okay, are you currently saving something, and what do you have, and are they right for you? And certainly, if you have questions or even want a review of your current insurance and investment assets, it's complimentary, of course, and you can certainly contact me to arrange that. I'd be happy to do that either electronically, or if you're local to me, certainly in person. Now, moving on to the last module. So we're almost all the way through the Money Magnet series. And module 5 is just kind of wrapping everything up. So we're going to bring it all together, everything that we've learned in the first 4 modules, just so that you can have a really great next steps in terms of pulling together your own financial planning and getting even closer to the money magnet that you are. So I look forward to chatting with you in module 5.